Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're going to be talking about investing today. I'm going to share with you some myths about investing. I'm going to dispel these myths. I'm going to show you the research, all right, the actual academic research that's available that proves that these myths, in fact, are just that. They're myths. They're not real. Okay, and then I'm going to share with you, time allowing, the truth of investing. We're going to get into that as much as we can this morning. So the first one is myth number one, and this is about stock selection. Choosing stocks based on a belief that they will do well in the future. That's a myth, okay? Investment advisors, or this is the myth, if you will, investment advisors can consistently and predictably add value through individual stock selection. Now, this is where this same thing goes with mutual fund managers, their ability. So if you hire or put your money in a mutual fund, if you're looking at your 401k and you're investing right in those mutual funds, there is a money manager, an investment advisor, if you will, a money manager of that mutual fund or a panel of people that work to, in this situation, are buying and selling stocks. All right, this is called active management. So the first basis here is, have you ever owned a fund? Understanding this, by the way, have you ever owned a fund that closed or got merged into another fund? Have you ever seen the funds available in your 401k change? Have you ever wondered why that would be and what happens? Well, there's research out there. There's through the Center for Research and Security Prices. This is commonly referred to as CRSP, and it's part of the University of Chicago's Booth School of Business and the CRSP Survivor Bias-Free U.S. Mutual Fund Database. So we can go and look now at this. So I'm going to show you, for instance, survivorship bias. This is when we're looking at the total number of funds that have been open. All right, so we'll show this next slide. As of 2015, over 33,000 mutual funds were open. All right, now this is the interesting part. The total number that had actually been created going back to 1923 was almost 60,000 mutual funds. So the question is, what happens to all those other funds? Well, they were killed off. They were closed, in other words. Over 26,000 mutual funds that had been opened have been closed. Now, why were they closed? And this is the part. When we look at the worst 200 dead mutual funds, they averaged almost an 80% loss in average cumulative total return per year. Okay, is it any wonder they got closed? But this goes back to active management. You ever see them advertise right on TV about a fund that lost 20, 30, 40%? No, I don't think so. They want to talk about the positive things, right? Well, here's the other end of that. We can drop that slide for now. Understand how this works then. Imagine, I'm going to use a metaphor, let's use baseball as a metaphor as an example. So how do they come up with your batting average, right? They look at walks, they look at strikeouts, they look at how many times you got a single, a double, a triple, a home run, right? And all that adds up and they figure out what your batting average is. Now imagine using this with mutual funds, when these funds talk at these fund families, and you can pick any one of them out there, whether it's a Vanguard, a T. Rowe Price, a Fidelity, it doesn't matter, right? This all works the same in the industry. So when you look at that, imagine, again, going back to the baseball metaphor, if I didn't have to count my strikeouts, what would my batting average look like? It'd look a lot better, wouldn't it? Well, imagine then if I close all those negative returns at 26,000 mutual funds, if I get rid of those, how does that make me look when I say this is our average return of our mutual funds, and I don't have to count the ones that had negative returns in the past? Isn't that crazy? And yet that's how the industry works. So that's one of the myths that we want to dispel. Now let me show you the average potential wealth lost through what's called active management. And I'm going to explain active management to you. So the first, if you look at this graph, on the bottom line, it is showing since 1972 through 2015, what the average amount of money made on an average U.S. mutual fund. So in other words, $100,000 invested on that very bottom line on your screen would have grown to $3 million over basically what amounted to about a 40-plus year period. Okay? Now, look, though, at the S&P 500 index, then the red. Okay? Almost, in fact, more than double your money over the same period of time by buying the index versus investing in those mutual funds. All right? So why would that be, do you think? Look at the average loss. That's the average loss of over $3 million on a $100,000 investment over the 40-year period. That's crazy. We don't want to have you do this, right? I don't want to see you lose this kind of money, which is why you have to understand how the active management system works when it comes to mutual funds, how that can happen, how they can be, why you're better to buy the index. Now, you'll also notice that red line has a lot more volatility, a lot more ups and downs, but what a tremendous return. Now, we're going to share with you the next slide, which is the average of all mutual funds. So now we're including not just stock mutual funds, but bond mutual funds. Now again, the very bottom line on your screen shows all mutual funds, the average. Again, that 100,000, now it only grew to about $1.5 million when you throw bonds in as well. Okay, about half what it did with just stocks only. But then look at that next line up, that 3,300,000. That is a conservative model portfolio that is based on the academic research, and this is the importance of asset allocation. That was a portfolio that was put together. It's got 25% of it is all that's in stocks and 75% in short-term investment grade bonds and fixed instruments of 1 to 5 years in duration, with maybe about less than 10%, I think it's actually about 7 or 8%, that's an intermediate 5 to 7 year, no long duration and no junk stuff in there. And that's very important. I'm amazed at how much of that is in bond funds today, and when I do analysis for clients. So here, look at that. And then the moderate portfolio, the next one up, 6,562,000, 4 times, right? 4 times what the average of mutual funds, and that is your typical 50-50 stock and bond portfolio, but it's utilizing asset allocation correctly to do that. All right, so this is why stock picking, this is one of the where research shows us stock picking doesn't work. Those average mutual funds, if stock picking worked, they would do better than those index or institutional funds just using where you're having passive management. Now let me explain those for you before we go on to the next myth. All right, we can drop that slide. So understand how this works. There's something called active management, and and another school is passive management. So what do those terms mean? Active management is where you're either buying and selling mutual funds. So you may have an advisory firm that you invest with, and they may swap out mutual funds all the time, trying to find a mix that's going to, they're telling you, well, this fund is good, but well, it's not as good now, or it was good for that time, but not for this next period. For this next period, we want this other mutual fund, or we found a better mutual fund, or whatever the story might be, right? That's active management on one level. Now here's another level. Let's say you're a buy and hold person. You recognize the importance is to pick your investments, to stay invested, and that everything will work out. And that's the school that you've been taught that by your advisors, even though they may not be following their own advice. And then you're investing in mutual funds, and guess what's happening in the mutual funds? They're buying and selling the stocks all the time. You'll see and one way to do this, when clients come in and I do an investment analysis for them, I pull Morningstar reports. I show them what they own. Okay, not just the mutual fund and what rating it might have, or someone's opinion that it's a good fund, all right, or its past performance being an example of what it may do in the future. No, we take a look at what it actually owns. How many stocks are in your mutual fund? All right, so for instance, if you've got a large cap fund, a large cap growth fund, well, that would be typically the S&P 500 index. All right, so we'd expect to see 500 companies represented there. But yet, when I look at most large caps, they have between 50 to 150, maybe a couple hundred stocks. In other words, a fraction of that in there. Why? Because the mutual fund manager is trying to pick which stocks out of those 500 he thinks will do better and avoid the ones he thinks are going to do, that are going to lose money, and thereby he's going to do better than the index as a whole would do. All right? Doesn't work. All right, there's the research again. What I just showed you was, in fact, how the average mutual funds, stock mutual funds, didn't keep up with like less than half of what the S&P did. In fact, I think it was about a third of what the S&P did. So one of the things that you see then with this is that this active management doesn't really work. And another thing that we'll get into later about cost, we're going to talk about turnover ratio, the buying and selling. So you're buying and holding, but they're selling and trading. Okay, so we've got a disconnect here between your theory, your philosophy and their philosophy, and we're going to get into that a little bit as well. All right, now one of the things, if you would like to get a personalized investment analysis, I'm going to be sharing with you all these myths, trying to help you as much as I can. But even then, it's still, how are we going to pick the ones in your personal portfolio? So if you'd like a personal investment analysis, be one of the first 10 callers to my office today. All right, 615-376-5325. You can bring in your investment statements. When you call in, you'll talk to Debbie. She'll get your information. She'll send you out a little checklist of things to bring, like your investment statements, brokerage accounts, that kind of thing. And we'll do an investment analysis. I'll pull the reports. I'll show you exactly what's in there, and I'll show you the risk associated with it and some of the hidden costs that you're not even probably aware of, and how it affects your performance, and how it can be really adding a tremendous amount of volatility or risk to your portfolio. So be one of the first 10 callers. Debbie will get your information. She'll send you out a checklist. She'll schedule a time for you to come in and meet with me. And when you come in, I'll also provide for you a copy of my book, 7 Steps to Financial Freedom in Retirement. There's a chapter in there on how the smart money invests that covers this briefly, and I'm going to get into it in more detail this morning. But first, we're going to take a break. So join me here, and then we're going to get into myth 2 about track record investing as soon as we return. Join us here on the Retirement Report.